The stock market is a complex and constantly evolving system that is influenced by a wide range of factors. One of the key drivers of stock market performance is the impact of world events. From economic indicators to political instability and natural disasters, world events can have a significant impact on the performance of the stock market and the investment decisions of market participants. To understand the effect of world events on the stock market, it is important to first consider the various types of events that can impact market performance. These events can be divided into three broad categories: economic indicators, political instability, and natural disasters. Economic indicators are key indicators of a country's economic health and performance. These indicators can include GDP growth, unemployment rates, inflation, and trade balances, among others. Economic indicators are closely watched by investors, as they can provide insight into a country's overall economic strength and future growth prospects. When a country's economic indicators are strong, it can create a positive environment for the stock market, leading to increased investor confidence and potentially higher stock prices. On the other hand, if a country's economic indicators are weak, it can lead to investor caution and potentially lower stock prices. Political instability is another factor that can impact the stock market. Political instability can take many forms, including changes in government, military coup, civil unrest, and terrorist attacks. When a country is facing political instability, it can create uncertainty and risk for investors, leading to volatility in the stock market. This can be particularly true in countries with high levels of political risk, where the stability of the government is uncertain and the potential for change is high. In these situations, investors may be more likely to sell off stocks as a way to reduce their exposure to risk. Natural disasters are another type of world event that can have a significant impact on the stock market. Natural disasters can include earthquakes, hurricanes, typhoons, and pandemics, among others. These events can disrupt supply chains, disrupt businesses, and cause damage to infrastructure, all of which can impact stock market performance. Companies that are directly impacted by natural disasters may see a decline in their stock prices, while companies that are involved in disaster relief efforts may see an increase in their stock prices. In addition to these broad categories, there are also a range of specific world events that can have an impact on the stock market. For example, tensions between countries or geopolitical conflicts can create uncertainty and risk for investors, leading to volatility in the stock market. Similarly, major technological advancements or scientific breakthroughs can also have an impact on the stock market, as they can create new opportunities for growth and innovation. To better understand the effect of world events on the stock market, it is helpful to consider specific examples of how these events have impacted market performance in the past. One such example is the global financial crisis of 2008, which was triggered by a collapse in the housing market in the United States. The crisis had a ripple effect on the global economy, leading to a sharp decline in stock prices across the world. In the aftermath of the crisis, many countries implemented a range of economic policies in an effort to stimulate growth and restore confidence in the markets. Another example is the COVID-19 pandemic, which has had a significant impact on the stock market. The pandemic has disrupted supply chains, disrupted businesses, and led to a decline in economic activity around the world. As a result, stock prices have fluctuated significantly in response to the evolving situation. Some sectors, such as healthcare and technology, have seen an increase in stock prices, while other sectors, such as travel and hospitality, have seen a decline. There are also examples of political instability impacting the stock market. In summary, world events can have a significant impact on the stock market. Economic indicators, political instability, and natural disasters are all factors that can affect market performance. Understanding the impact of these events is critical for investors as they make decisions about where to allocate their capital. While it is impossible to predict with certainty how world events will impact the stock market, there are steps that investors can take to manage risk and protect their portfolios. One approach is to diversify investments across a range of sectors and regions, as this can help to mitigate the impact of any single event on a portfolio. Another approach is to carefully monitor world events and adjust investments as needed in response to changing conditions. Ultimately, the effect of world events on the stock market is complex and multifaceted. By staying informed about the key drivers of market performance and taking a proactive approach to risk management, investors can position themselves to navigate the ups and downs of the market and achieve their financial goals.